All right, my friends, this is the good and bad of investing. I'm going to show you the good and bad using the USAGX, which is the USAA Gold and Precious Metals Fund. Because the start of this century, that sucker kicked butt and took names. The end of the last, basically 10 years, it got hammered. I'm going to show you what it looks like both. Now, I did use the USAGX as a kind of the bulwark, if you will, of our best retirement plan. I hate to say the best, but it's like we're taking 4 or 5 funds, we're putting 25% in each and never rebalancing them, or putting 20% in each and never rebalancing them, just pulling money off. The USAGX is really what was the stalwart for us for the first decade. And then after that, it got hammered. But by then, it served its purpose, no other way around that. So I wondered what it did just on its own. So let's take a look. Let's dive right into this. This is interesting to me. So we're going to do 2 things here. We're going to show you the real numbers, 2001 through 2017. Then we're going to reverse the order. What if you started in 2017 and then you basically started when the market was getting crushed? What did it look like then? So a lot going on here. So stay tuned. Don't forget to subscribe, comments, thumbs up. The whole thing helps a lot. So let's get rid of this, minimize my big head. All right, so this is USAGX, the USAA Gold and Precious Metals Fund, the best fund of the decade from the beginning of the century. So from 2000 to 2010, this is Morningstar's best fund of the decade. And as you can see here, in 2001, and I'm not using 2000, just started 2001, up 30%, 67%, 71%, fell 10, up 33, 43, 27, fell 25, up 62, up 40. I mean, you just can't beat that. That is phenomenal. But then watch. All right, then it was down 20, down 12, down 51, down 8, down 26.5 consecutively, up 46, up 9.65. But I mean, it just got hammered the second decade. All right, so now we start with $100,000. All right, we're going to pull, in this case, we're pulling 5% of the portfolio a year off. So we're starting with $100,000. At the end of the year, we have $130,000, which means we get $6,548 of income. Excuse me. After the end of the year value minus the amount of income, we start with 124. We've doubled our money in 2 years. Now we're up to 208. We have $10,000 of income. The following year, we're up to $200,000, up to $339,000, and we're taking $17,000 of income. So if you were lucky enough to have invested in this in 2001, your $100,000 grew to $339,000, and you were able to take almost $35,000 of income, which is just insane. The following year, we did take it on the chin a little bit. We're down 10%, so we're at the end of the year at 287. But then again, we're up to 380, up to 518, up to 624 at the end of 2007. So our $100,000 at the end of 2007 is worth $628,000, and we pull $31,000 a year off that. It just shows you that if you're in the right place at the right time, you can be wealthy investing. No other way around that. Took on the chin in 2008, not nearly to the extent that the S&P 500 did, but our 628 fell to 450. Oh no! And we're only able to pull $22,000 out. By the end of 2010, though, we're back up to 923, my friends, and pulled $46,000 out. I mean, that's just, again, we started the century at $100,000, or this is at the end of 2000, at the beginning of 2001 at $100,000, and then we, by the end of 2010, we had $923,000, and we had $46,000 of income, just taking 5% a year off. Insane. Now the bad stuff happens. We went to 706, 591, 273, 238, down to 166 by the end of 2015, and we're only able to pull $8,300 off. So we ended this time frame at $240,000, and we're pulling $12,000 a year off. So when all was said and done in this fund, though, we ended with $228,000 total cash value. And if we look at it relative to the Wellington, remember, because we've looked at the Wellington quite a bit, the Wellington ended at $149,000 in cash value. We're still almost $100,000 above Wellington, and we took $350,000 of cash out, and the Wellington only took $102,000. And the Wellington was our shining shining city on the hill. And yet, look at this. Relative to the USAGX, I mean, it was not even close. We still more than doubled, not quite doubled, almost doubled what the Wellington had in terms of overall cash value with the USAGX, and we took over 3 times it in income. Crazy. Now, if we did, what's this? This is, again, 5%. What if we just said, I just want to show you what would have happened if you just dumped the money in and never touched it, so you weren't taking money out. Put $100,000 in 2001. By the end of 2010, it's worth $1.46 million. Can you believe that? At the end of 2010, your $100,000 is worth $1.46 million. Then it went down all the way $341,000. So if you put $100,000 in 2001, by the end of 2015, it's still worth $341,000. But that's $1 million off what it was just 5 previous years. I mean, that's, it went from 1.465 all the way down to 341,000. Now, you still closed out 2017 at 546,000, so nothing to be shameful about. But I mean, you're still down $1 million. $1 million. It's crazy. That's the good and bad of investments. $100,000, you made it all the way up to 1.45 million, 465 million. $100,000 went to 1.465, and it went down to 546. You made $1.3 million in this fund in that decade. And then you lost $1 billion of it. Now, if you would have invested in 2008, your $100,000 is only worth $63,000 at the end of right now, at the end of 2017. So, I mean, again, there's where you go. If you went into the down market, you are in a world of hurt. In fact, look at that, your 121,000 that you started with in 2000, and it went from 171 to 63. So if you started, I wonder if we did, let's try it. Well, I don't want to do that. I want to do so. Let's do this. Let's start with $100,000 here, 2,000 right there. So let's do 100,000 times this guy right here, right? Yeah, boink. Oh, man, hold on a second. 100,000. Oops, we got to do the equal sign. Equals $100,000 times this guy right there. Boink. And then we're going to do this times that. Boink. And so if we start with $100,000 in this guy, and well, that's not so bad. Am I doing this right? $100,000 in 2010. Oh wait, that's $1 million. I want to start with 100. That's why I was like, well, that's a lot better than I thought. Yeah, so we're down to 37,000. So if you would invested $100,000 in 2010 with this guy, you're down to 37,000. If you invested $100,000 in 2008 with this guy, you're down to 63,000. If you invested $100,000 in 2009, you're up to 125. But the fact that you missed those previous 8-9 years of 2000, the early part of 2000, you're in a world of hurt. All right, so let's go down now. If we did 5% initially, so 5,000 plus adjusted for inflation each and every year. In this case, our portfolio value is worth $418,000, and we're able to pull $108,000 out. But watch this: at the end of 2010, we had 1.26 million in there. I mean, and it went all the way to 271,000. I mean, you lost $1 million. I can't even imagine what that's got to feel like. And again, if you're doing it as an income stream, you started with $100,000 and you're taking, what's that, 5%? No, that's 5,000 adjusting each and every year with inflation. You're down to $17,000. If you started this in 2008 and you're pulling 5% initially and adjusting it each and every year with inflation at 3%, your $100,000 is down to 2.78. Yeah, I mean, 17,000. I don't know where I got 2.78, down to $17,000. If you would have started in 2009, you're down to, we already talked about that, 37,000. I mean, look at, geez, I mean, just to shows you, look at that. You're down to 12,927. $100,000 starting in 2008. you're down to 12,927 at the end of 2017. So is that 10 years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. After 10 years, you got 12,000, 13,000 bucks to show for it. Oh, yeah. All right. So now let's reverse these. All right. So here, all right. So remember the before, what are we taking off here? We're taking off here at 5%. So here we took off 5% starting in 2001. We took out $350,000 of cash, and we got $228,000 left in our portfolio. So we're going to reverse the order now, starting with 2017 as if that was 2001, and going to 2001 as if that was 2017. So here our portfolio is still worth $228,000, but we're only able to take $76,000 of cash out. That's it. Because look at this, in this year right here, we only took $1,700 out. And what you can see here is we did fine the first 2 years, but then 2015, 2006, 13, 2012, 2011, we're down to $27,000, and we're only able to take $1,300 off. We're up a little bit the next year. I mean, a lot. That's a 39% increase, but we're only up to 1823, and that's the reverse order. I mean, look at that. We're still we're down to 228 total, which is pretty good. I mean, at the end of the day, that's still better than Wellington. Wellington was up to 149, but we're only able to take $76,000 of cash out. The question is how many people would have stood in there. They put $100,000 to start there. They're only down to 27,000, and they're pulling $1,300 out. And I doubt you'd be able to stay. Here's what happens if we take 5% a year to start and adjust it each and every year inflation. And this time we actually run out of money, and we just reverse ordering here. So here we have at the end of 2017. Again, we're reversing this, but we had 104,000 because we got 9.65% of growth. 109,650 minus 5,000, 104.65. The next we have 104.65 times 46.26%. So we're up to 153. We're only able to take 51.50. That's 5% initially, minus 3% with 3% inflation, down to 147. Then we got crushed down 27%. We're down to 103. Then we got down 8%. We're down to 89. Then we're down 51%. We're down to 37,000. Then we're down another 12%. We're down to 27,000. Then we're down 19%. We're down to 16,000, but we still need 6,149 off the portfolio. So even though we're up 39%, we're only up 39% from 22%. A $22,000 portfolio, and that means we have to take 5,900. We're up 20. So even though we're down to $22,000, and the following year we're up 39%, we're only up 39% from our base of $22,000. But we still got to take $6,100 off, and if you look at it, $6,100 divided by a $22,000 portfolio, 6,100 divided by 22,000. That's a distribution of 28%. It's not going to survive. The following year, we're up 62%. But because we're taking 6,300, that 62% is 62% on a very low base. So we're taking 6,334 divided by 26,888. Oops. 6,334 divided by 26,888. That's again a 24% distribution rate. The next year we're down 24.58. So now we're down to 15,000. We're taking 6,500 off. The next year we're up 27%, but it doesn't matter because we're taking 67% off, $6,700. So even though we're up 27%, we're not even up. The amount that we're taking as a distribution dwarfs what we're getting rate of return. The following year, we're up 43%, but it doesn't matter. We only have $6,792 left in the portfolio, and yet we need $6,921 of income, and then kaboom. And we missed 71%, 39%, 67%, 31%. We missed it because we ran out of money. And that's the drawback about taking 5% and adjusting it each and every with inflation. If your portfolio is getting hammered, you're taking more and more and more as a percentage out. It's not 5% anymore. It's 27%. Here it's 6,700. It's more than 50%. So even though the portfolio is up 27%, it doesn't matter. It's up 27% from a lower base, and we're taking significantly more off. That's just sad. So that's a tale of two portfolios that just, I mean, oh man. That's why I got to be diversified. But look at that. If you had, you're talking $1.4 million in your portfolio. And then you're talking all the way down to 341. I mean, a $1.1 million loss. Anyway, so I hope that helps. That is just interesting to me, the tale of two investments, the good, bad, and the ugly. That's a USAGX for you right there, part and parcel. Now, if I were an investor, a speculator, which I'm not, I just say, look, in 2011, 12, 13, 14, and 15, 20, 12, 51, 8, 27, we've had 2 good years since. Does that mean there's opportunity there? I think so. Absolutely. Should you buy it? I don't know. But I'm telling you, once you have that kind of craziness, that might mean there's a good opportunity to put some money into a gold and precious metals fund. All right. As always, you like what you see here, my friends, subscribe down below. Much more on this. We got a lot more topics just like this to talk about. So let me know what your thoughts, and we'll see you guys next time. A thumbs up in the comments always help too. Thanks, guys.